ended up Friday on a down day.
Yeah.
And then, there's probably a lot of things that go into this, but my knee-jerk reaction is the A team is gone and the B team and the computers have taken over. And that's generally what's going on, right? Because you had a holiday week for Christmas, followed by another holiday week with New Year's, and so the A team is probably out skiing somewhere.
That's right. I would assume so. And really, this gets me to the idea of a Santa Claus rally that probably a lot of people have heard about. And that's this concept that if you look at the last 5 trading days of the calendar year and then the first 2 of the next year, that's traditionally what's known as the Santa Claus period in the markets, even though I'm a bit of a traditionalist with the 12 days of Christmas, right? It starts on Christmas, goes through Epiphany. So maybe it could be, who knows how many trading days are in there. But going back to 1926, we have seen that during that period of time, the last 5 days of the year and first 2 of the next, the market, the S&P 500, is up roughly 78 to 79% of the time. But it's not like it's a straight line up. It's not like every single day is up.
It's another coincidence indicator, Santa Claus rally and all of these things that we talk about, elections and who wins the Super Bowl. Those are coincidence indicators.
So you don't think if the AFC team wins that it's good for the markets?
I certainly hope not, right? So we'll have to see. Anyways, we'll look at, you look at Treasury yields that has spiked. Now that's something that's real that we can measure.
Yeah.
And when you see Treasury yields get up to 4.6%, that's a significant move. That you can measure, number one. Number two, why is that happening? Inflation and tariffs, right?
Yeah.
Anticipation of inflation and tariffs could be in there. But I think more importantly, you're seeing the computers take over. And, the real traders are gone. You're seeing some inventory blow off. I think that's probably a more realistic explanation.
Yeah, and I think that I agree. It's really retail driven because most of the time the institutional investors aren't doing a lot of trading around this time of year, so it's more retail driven. There's also not a lot of data that comes out. If we look back at what happened this past week, we had the consumer confidence numbers, initial jobless claims. There was some housing data. Next week, there's going to be some housing data. But it's not a lot of these, kind of the first tier level of data that typically moves the market. So you almost have this vacuum of information.
Right.
And I think that the Santa Claus rally could be retail driven. And also, when the market isn't buffeted by news from data releases, politicians, Fed speakers, Fed speakers is a big part, the market has a tendency to go up.
Yep. So I was certainly hoping that you weren't going to talk about the reality of Santa, because that would not be good for some of our audience right now.
That's right.
So let's talk about really what's going on. We talked about globally, but, I've read in the newspaper recently that Mr. Trump wants Greenland and Panama as other parts of the state. So you look at that stuff and is it incendiary? Are people paying attention to it? That's one thing. But what is real, though, is what's happening around the world. You see, for example, the ECB, the European Central Bank, they're going to have to lower rates because France, Germany, the rest of the European countries are under pressure.
Oh, they really are. And I would throw in there that the United Kingdom, so yes, the ECB, so European Central Bank, they focus on the Eurozone. So those are the countries that use the euro as their currency. And then you have outside of the Eurozone, there's the United Kingdom. So they used to be part of the European Union, which was a trading group, but they have their own currency, their own central bank, and they're also under pressure. So when we look at Europe as a whole, they have not had a great year when it comes to growth. We look at what happened in the United States, pleasant surprise to the upside with growth. Well, over in Europe, kind of across the board, it was almost a unpleasant surprise to the downside, and that has continued through the last couple of months. There aren't a lot of indicators that have come out this past week or the next, but the most recent one that we saw was from Standard & Poor's. They have this Purchasing Manager Index for every country. So they go around and ask these surveys about manufacturing. Is it expanding or not? Services expanding or not? And while in the U.S., services has been doing the heavy lifting. Over there, services has been kind of stumbling lately.
And you think about not only over there, right? You're talking about the ECB, but you can go around the world and see, China has stimulus. Brazil is being devalued. And of course, South Korea might have their third president coming up here. So, there is uncomfortable feelings geopolitically. Here's the good news. The U.S. remains the oasis. We have growth here. We have service industry, as you talked about. we may have a little bit of inflation, but
Sure.
I mean, the feeling is that, next year, 2025, we're going to see some M&A. We're going to see an easing Fed, a continuation of the easing Fed. It's pretty good stuff, right? And so if you want to put a portfolio together domestically, there's still a lot of opportunities.
Yeah, it really is. And when we look at the Standard & Poor's 500, where do they get their revenue? 40% of it comes from outside of the United States. So I think there's an argument that can be made that by investing in U.S. businesses, you do get some of that global diversification. Maybe not as much as what some clients might want necessarily for their financial plans and for diversification purposes. But when we look at the lens, not just where are these companies domiciled, that is, where are their headquarters, but also where do they get their revenues and profits, the U.S., it does look like to be a pretty good place. You were mentioning about with the like in China with their currency. When I was on CNBC this past week, it was a lot of fun talking to the hosts about tariffs and how the currency so the U.S. dollar has actually gone up in value. A lot of it, especially relative to China, maybe in anticipation of tariffs being applied. So we do have some dollar strength. That could be maybe a little bit of a headwind for U.S. companies exporting abroad.
Yeah, to wrap this all up, when we see that the dollar is strengthening and commodities are priced in dollars, and again, you're talking about imports and exports, that is a good thing.